What's going on, guys? Welcome back to the channel. My name is Matt. So we got the rate cut yesterday. As predicted, rates dropped 25 basis points from the Bank of Canada. No big shocks. This isn't really honestly big news just because this prediction was so baked into everything that it's honestly not a big deal at all. So what I want to talk about today is something a little bit different. I want to talk about how Canadian banks are starting to rethink their approach to the mortgage market. Okay, so with competition heating up, they're really starting to ask themselves how aggressively they should be going after new customers, right? Because right now, the banks are really competing aggressively for new business because there's a lot less of it. Okay, a lot less mortgages are being funded because a lot less people are buying right now, right? So what happens is there's less of a pool of mortgages out there for a smaller pie, or let's say, right, for the banks to take and make money on, right? So what happens is the branch level banks, TD, RBC, Scotiabank, CIBC, they're all really competing very aggressively with each other, effectively undercutting each other with rates to win business, okay? I've seen this myself because I've now lost multiple clients to just branch level TD, people going to their branches and then their banks are giving them these like fantastic rates that I can't offer even through the same bank. Let's say I can work with the same bank, I can't get that same rate. Okay, so they're really undercutting the broker lines and stuff now, which is, it's not a great thing, but I mean, they are able to do it, so they're doing it, right? They're trying to win business, right? They're trying to get business. There's less business being done, so they're trying to capture more of it. And so RBC CEO Dave McKay recently spoke at the Scotiabank Financial Summit, and he mentioned that they're being more cautious when offering mortgages. Basically, they don't want to chase customers who are just shopping around for the lowest rate, especially if those deals don't meet their profit goals. It's interesting that he says that because what they're doing is exactly the opposite. They're actually just chasing people with rates. And I think what they're doing is they're trying to capture business, and then they're trying to put some fine print in the mortgage saying, if you ever need to cancel this, you're going to be hit with a $20, $30, $40, $50, $60,000 penalty fee if you ever need to port or cancel the mortgage. And so that is how the banks are positioning themselves for to make a lot of profit in, let's say, the near term if people ever need to cancel their mortgage. And so it says it's no secret that the housing market has slowed down, obviously due to high interest rates, right? We know this. And that's made things really competitive for all the banks and brokers too. So McKay's even described the Canadian banking system as ruthlessly competitive oligopoly. And he pointed out that unlike the US, where banks pass higher costs onto borrowers, Canadian banks have to absorb those costs themselves, squeezing their profit margins. And that said, RBC is still going after clients who they believe will have a long-term relationship with the bank, right? Those who are likely to use multiple products, not just the mortgage, right? So banks make money a number of different ways, not just mortgages. But right now their profit margins on their mortgages are being really squeezed, and they're a lot smaller than they used to be. And so Scotiabank is following a similar strategy. Their CEO, Scott Thompson, is focused on building a multi-product relationship with clients, right? So Scotiabank has cut back on customers who have only a mortgage with them by about 14%. They're shifting from going from sheer volume to focusing on value. And I mean, that's good. Scotiabank is doing good by focusing on that. So if a client is only shopping around for the best mortgage rate, they might not fight as hard for that business, right? So if someone's looking to have multiple accounts or services with a bank, right, Scotia is willing to offer more competitive rates, right? So interesting take that they're doing that. Now with the Bank of Canada obviously recently cutting rates yesterday, there's a chance that the mortgage market could pick up a little bit more here, okay? There's a chance. Now banks have dropped their prime rates in response, but the margin they've added to the prime rate remains higher than it used to be, okay? And this is what's cutting into their profits. And even though banks expect customers to negotiate lower rates, it's tough to say what their real margins are, right? And despite rates coming down, RBC's McKay noted that they're still working to cut costs in their mortgage business because they expect the pressure to continue. And that's what's happening on the mortgage front, right? But some banks like TD and BMO are also dealing with the challenges in the US market, right? So TD is working through investigations into its anti-money laundering program. BMO's had some struggles with credit losses, mostly due to the pandemic. So both banks are confident that things will improve, but they're acknowledging that, obviously things will take their time here. And so in short, Canadian banks are being more selective about how they compete for mortgage customers, but at the same time, that's what they're saying. But what I'm seeing from my perspective in the business is that they're not. They're actually undercutting each other and every other competitor with just pure numbers, right? They're just undercutting to win business, right? And unfortunately, it's cutting into their profits, right? Because they're trying to just keep things afloat. So to me, this is not a good thing, because this is showing that if Canadian banks are struggling this much where they have to undercut each other for business, this is not good for Canadian banks longer term. And it's also not good for Canadian real estate. I think in general, if you got to compete on just price, that's not a good thing. That means that there's really not a big offering. Like, if you want to know my true opinion, I think if you go to a bank for your mortgage, okay, they'll offer you 2 products, okay? And yeah, they can obviously lower their rate a lot, but you got to be careful, because a lot of times in those value products they're going to give you, they're going to put something in that fine print and it's going to screw a lot of people. So you got to be very careful long term about that. You get this fancy rate, but then they'll sneak something under the rug and it'll bite you later on. If you ever need to cancel the mortgage or move it or do something with your mortgage, even if you need to refinance, okay? If you need to refinance, they could hit you with that fee. And so you have to be very, very careful about these things. And I think long term, I think obviously this will change. I don't think this is going to last forever, but I do think that, it's not good for the banks, right? I think in general, if you go work with a broker, they can offer you thousands of different products, not just 1 or 2 or 3 products. They can offer you thousands from different brokers that have different fine print, different, let's say, specifications of the mortgage, different policies. If you ever need to get back out, or you need to move it, or you need to cancel, or you need to refinance, whatever it is, there's lots of different options out there. And I recommend you talk to a broker. If you want to speak with me, I'll leave my information down below for you guys. And obviously, if you guys like the video, hit the like button. It really helps me push these videos out to a new audience who might really benefit from the information. And until the next video, guys, take care.